Eric Muadh, Muadh.com, with world market analysis for the weekend of February 6th and February 7th, 2016. Let's take a look at how Asian markets closed, and we can see Friday's action was pretty much mixed bag. I'll call it down as far as Japan is concerned, and we see here Singapore market was up, and also we see that Japan was down slightly. So that's Asia. Let's take a look at European markets, and we can see at the close of Friday slightly down, about, let's call it about 1% down on the major averages in Europe. Take a look at the Americas right now, and we are looking at Brazil, which is unchanged, and other markets are slightly down. Take a look at the US with about 3 hours to go before Friday's close, and we can see right now US markets are down. Nasdaq is down about 2.5+%. S&P 500 down about 1.5. Dow is down about 1%. So let's take a look at world chart to see what we have. So let's begin by taking a look at the Australian market. We can see here, if we take a look at the monthly closing lows going back to late 08, early 09, and connecting through the lows of 2012, 2011, and recent monthly closing lows, we can see that right now we are on the line, and if we continue lower and break this support trend line, chances are that the market is going to be ready for a major slide. So the risk here, as we are going to see in many of the world markets, the risk is for markets to go lower just based on the fact that they are not trading and showing support right now, beginning of February. And I'll show a different view, which is take a look at the 3-year monthly chart for the Australian market, and you can see that as of right now, the 3-year monthly looks like we are still trading at 3-year lows on price, or at least close to breaking down below 2015 monthly closing low. RSI is just about to move below to 3-year lows. That's a major risk. And we see that the MACDs are trading at 3-year lows. So the risk remains that even though day to day might be different, but month to month, week to week, Australian market also might be setting to go lower. If we take a look at the weekly chart, the test now is going to be whether the Australian market can hold above 4948, so 4948, which is a recent weekly closing low. Anything below that would suggest that we are entering a fresh break and that markets are truly in trouble. So that's short-term risk, is if it breaks below the recent weekly closing low. Now, if you go back to the previous level here at 5,060, once we broke through that, after breaking through that, we've been unable to move and close above that threshold. So the market here continues to be questionable, in my opinion, because we haven't even reclaimed the previous lows for 2015 on a weekly closing basis. Every time we try and move higher, the market's been smashed back. For example, if you take a look at this red line here, which was a break signal in August, so we came off those highs, and every time we hit that red line, we pull back. So that has been the routine here recently. Every time we hit that level, market's been pulling back. So the risk continues that the market here is being pressed down, and for short-term basis, watch the market to see whether it can hold above 4948. Otherwise, a break of that previous recent weekly closing low, then that might be another fresh sell signal. Let's take a look at the Hong Kong market, and we can see here also trading at fresh multi-year monthly lows in price. RSI moving to 3-year lows here, and also the risk is that the market stays below 38.2 on its monthly. As it moves below 38.2, you tend to get this type of a big reaction lower. So the risk is still to the downside. Also, the MACDs are pointing down at 3-year lows. And so again, we see another market confirming that net world markets are trading as if they still want to go lower. If we take a look at the South Korean market, KOSPI, if we take a look at the daily, we can see that it's had a nice relative bounce off the lows here. But I think it's coming back to a level where it might find some resistance, which is the top side of its daily RSI, connecting the highs throughout all these highs here, and closing here for the last couple of days suggests that if it is to follow world markets, more than likely around here it stalls and starts probing lower prices, and unless it can clear that resistance line. Otherwise, if that is resistance is confirmed, we should expect a pullback from current levels. Take a look here at the monthly, and like other markets, we see that the monthly continues to be trading close to fresh monthly lows here in price. RSI is trading at 3-year lows, so the risk is still to the downside, and MACDs are still trading at 3-year lows. So we have a major risk that the KOSPI also might be looking to go lower, and potentially substantially lower if this chart is to be respected. Take a look at the Nikkei, and we can see that the Japanese market here had a nice run from the lows here of 1600 and rallied back to about 17,800, somewhere thereabouts. But we can see that that was coming back to test the break of December. So this break in December brought the market off those highs here in the 19,750 level. And so if you draw a line from there, something like that, just slightly above 50, we can see that every time we hit that line of 50 and show uniform activity rejection, we get a sharp pullback. And also over the last couple of days, this past week, we hit that line, and now we are now seeing a sharp pullback. So I think net we can see here is a market that is also stalling. In fact, if you take a look at the monthly for the Japanese market, you can see that the risk is we stay below 50 on the monthly RSI. We are seeing that the RSI is trading at 3-year lows, so the risk again continues to be markets to be probing lower prices. We can see we are trading below 2015's monthly closing low, and as long as we are trading below that 2015 monthly closing low, the risk yet again continues to be for a major drop. And we can see that MACDs are also pointing down because they are trading at fresh 3-year lows. So the risk continues to be down. We can also see that the MACD here is trading below 0, and that again is another sign of a market that is I guess showing us some red flags. If we take a look at the Nifty, we can see here that the risk is still for lower prices on the monthly until we can recapture that 50 level on the monthly RSI. This remains a major risk, suggesting much lower prices and potentially substantially sharp lower prices because of the way the monthly chart looks right now. The risk is there to the downside. MACDs are trading at 3-year lows or close to 3-year lows. So the risk here, as is pretty much the theme in most of the markets, is for downside action. We take a look here at a long-term monthly view going back to 1990. And simply put, you can see that whenever we trade below 50, markets are generally bearish. So all these periods here, when markets were pulling back, is when the RSI on the monthly was trading below 50. So that's a simple way of putting this, all this 2008 during this period, and also this short period here during this drop. And so for the market to do well, it needs to recapture the RSI 50 level and trade above it. Otherwise, this is a market that could easily continue lower. And again, you can see that the market does well when it's trading above 50. Pretty much that's a theme on all of these world markets. They need to be above the 50 level at least to support higher prices. Right now, the Indian market is showing a trendline break. If you go back to the lows of 09, you can see that this break took place end of 2015, and we are still seeing markets struggle to make higher prices. If we take a look at the 2-year weekly, here was a recent weekly closing low in January, and the level to watch there that the market needs to support is 7422.45. So which is a recent 2016 weekly closing low, excuse me. So it's a weekly closing low. If we break through that, remember we've had 2 weeks since recording that low, so any fresh break below 4722.45 would be a fresh break, suggesting that the market would have fresh legs to probe lower prices. So anything above that is good. A break through that would be bearish short term. So watch that level, set an alert. Anything below that means that the markets are scary to the downside. Now, if we take a look at a 5-year weekly chart for the Nifty, we can see a couple of, or at least one line that shows where it has been bouncing. So since the lows of 2011, late 2011, early 2012, market's been bouncing on this line here for nice multi-week moves to the upside. So this has been a nice place to re-enter the market after pullbacks on hindsight. And again here, all this led to successful multi-week rallies. Now, what we are facing here is the possibility that this becomes resistance. So for the market to start grinding higher, it needs to trade above that blue line. Otherwise, if this becomes resistance, for the first time since 2011, we might start seeing this being resistance, and now the market might be looking to continue trading lower unless it can reclaim this line that has been support on the 5-year weekly chart. Now keep in mind, even if the market was to move higher for a couple of weeks, it's gonna immediately have to contend with this downside resistance coming from the RSI topside resistance. So even if it was to move higher, you can still see that this is resistance, that it has to decide whether it can move above that. In other words, there's a lot of work that needs to be done to repair the charts. My personal thinking right now is the path of least resistance is down, and not just down like a couple points. I'm talking about 10%, 15%, 20% lower, quickly and in a hurry, unless the market finds support on the previous weekly support line going back to 2011. But the risk still continues to be to the downside until we can see it break out above recent resistance levels. Let's take a look at the South African market, which had staged a lower weekly closing low, but an improvement in RSI action. That positive divergence has led to 3 weeks of a nice move higher, but now we are coming back to test resistance, which so happens to be around the 50 RSI level on the weekly RSI. And so if we draw a line somewhere around here, this is where it's been stalling since this most recent break there. So it broke down here in November for the highs there. This became resistance again in the month of December, and now we are coming back to test that. I think around here is where it stalls, because if you take a look at the daily is showing that it's coming back to test the break level of November. So this break in November, so let's just draw, so this area here broke down in the RSI, came off the highs there. We draw our uniformity line, something like that. You can see that since then, this has become uniform activity rejection for the highs there, uniform activity rejection for the highs there, and now seemingly might be forming a double top, which might be another short-term high. And also we are testing a downward declining 50-day moving average. So I personally think that this is probably around where it stalls and starts pulling back. Also take a look at the line connecting RSI highs, and you can see that we've come close enough to test that topside resistance on the daily. So more than likely, I would not be surprised that this, also taking a look at how world markets are shaping up, around here it stalls. If we take a look at the monthly, we can see that still, as of right now, we are looking at a market that is trading at 3-year lows on its MACD. Both MACDs are trading at 3-year lows. RSI has been trading at 3-year lows for quite a while. In fact, broke down about middle of last year to fresh 3-year lows on the RSI. And even here, we are still looking at a market that is still showing the RSI on the monthly trading at 3-year lows. Net, in my opinion, the risk still continues to be to the downside. If we take a look at the Nigerian market by way of the ETF that trades in the US, NGE, we can see here that it still continues to be bearish. Why? Because it's trading below 30.90 on its monthly RSI. Pressure still means that for now, until it can move above 30.9 on its monthly, we should be expecting this still to be looking to trade at lower prices. Let's take a look at the FTSE, the London Financial Times Index, and we see here, as we had discussed over the last couple of weeks, it had come back to test this resistance line on the daily. This line has been a problem. Take a look at double top resistance around that red line for the highs there. Uniformity rejection for the highs here, and again uniformity rejection here for the highs here. Also happens to be resistance around a declining 50-day moving average. So that net suggests that still we are looking at markets that are looking to trade lower. If you take a look at the weekly, we can see that over the past 2 weeks, we did try to move above a declining 10-week moving average and failed. We also see that we came back to the test of this level here, which has been a problem. This RSI break took place sometime there in August, and since the break in August of the weekly trend line of the highs there, every time we hit that level, the market seems to form a short-term weekly high and pulling back. So we see this also happen over the last 2 weeks. We came back, and just as we had discussed, that was going to be an area of resistance, and that is exactly what happened. So now the risk is, if it can hold or if it breaks through recent weekly closing lows for 2016, the level to watch there is 5804.10, which is the recent weekly closing low. Anything cracking below that would be a fresh break after it has had 3 weeks of rest above that closing low. So anything below 5804 is a fresh break, suggesting much lower prices. Keep in mind that on the monthly, so like other markets, we are trading at 3-year lows on the RSI on the monthly, which is a major sell signal. We are also trading below 38.2, which is an area where instruments tend to crash. And also we are looking at the MACDs trading at 3-year lows, have been trading at 3-year lows for many months. And even here, trading at 3-year lows and also trading below zero on the monthly MACDs, suggesting that there's little momentum to the upside as of right now. Take a look at the French market, and just like the FTSE, you can see that here it might have a chance of breaking down to fresh 2016 weekly closing lows. The level to watch there is if it can hold above 4210.16. Any break through that, which is 2016's weekly closing low, would be a fresh break, suggesting fresh momentum to the downside. As an example, take a look at this break here that took place in December, or actually January, that began a fresh momentum move lower. So here the risk is that it could repeat the same thing. So the level to watch there is 4210.16. Anything breaking through that would actually suggest much lower prices. Of course, we know that there's support potentially if you go back 5 years on the weekly, just like we saw with the Nifty, for this to be support area. And so we can draw a line here where the market has been using this area for support on the weekly chart. So somewhere around, let's just draw it there, right there. And this shows where the market has been finding support ever since it moved above that level here. Market came off the lows, held here for the lows there, touched it here for the lows there, support with uniform activity here for the lows there, again support here for the lows there, support and support on price. Here also it went below it and back above it for a multi-week rally. And so we can see that maybe for the first time in many years, this is becoming resistance. So the green line has been support. The more it stays below that line, the more we see market struggle. The 3-year monthly chart also looks bearish because we are trading at fresh lows in terms of the RSI. We've seen that everywhere we look. So that's a market that is not healthy and could actually see lower prices at this rate until we see fresh evidence to the contrary. We can also see that at least one of the MACDs is trading below zero and trading at 3-year lows. So the risk is still for lower prices. If we take a look at the German market, and we are going to draw the same line, this is a 5-year weekly chart, 5-year weekly, and there's a line right there which has been good support for this market going back to 2011. Nice lows for support there on the green line, support again there, and came close here and held. Support here, double bottom support for the lows there, and even here it recaptured back above that line, which is this entry, for a nice multi-week rally. And now, depending on what happens, if we stay below the green line, then this is a different market as opposed to this nice upward trending market over the last couple of years. If this remains as resistance here, if that is resistance, then we are now looking at a market with different makeup, different DNA type action, more than likely. this might actually lead to much lower prices. And of course, we know that the monthly is also breaking down as far as the German market is concerned. There's no surprise here, because as we break through recent 2015 monthly closing lows, as we've seen across the globe, the risk continues to be for much lower prices. RSI trading at 3-year lows, and MACD is also trading at 3-year lows and below zero. So you can see below zero, 3-year lows, and the main MACD just now moving to fresh 3-year lows. That's the worst type of sell signal, or the strongest type of sell signal, indicating that the risk continues to be to the downside until the market can prove otherwise. If we take a look at the Canadian market, at the end of last week, we had discussed that it had come back to test the top side of its weekly RSI, and I think it's still showing that it is not able to move above that. In my opinion, this becomes a problem. Until it can clear that resistance, one can still expect this market to be on a pullback mode. So that's one layer of resistance. There's also another layer of resistance that is still playing out, which is this level here, which has been a problem since the break right there sometime in June. So since this break in June, when the market came off these highs here, this has been a problem. Market has been unable to move above that red line. The more we show resistance there, and again, the more we show resistance on the top side line like that, the more this market is going to have to pull back for now. We take a look at the daily for the Canadian market, and we can see that it is forming a double top, just like the South African market might be doing. If you go back and take a line right there, this has been a problem since the break here of the highs at about 15,500. It was resistance at the red line here, at the black line there, resistance with uniform activity here for the highs there, came close for the highs there, and now we might be forming what seems to me to be a double top, as you can see here. So there seems to be a double top as of right now coming in play, more than likely also showing resistance here at a declining 50-day moving average. You put all that all together, the fact that world markets don't look healthy, we can see that this could easily become an area where this pulls back. It's coming back to show resistance on the top side of its hourly RSI right now. Also a slight higher high. While we're doing that, we can see a slight lower low on the hourly RSI. Again, net, I think this suggests that we're still looking to go lower. Keep in mind that on the monthly, nothing has changed. We are still trading at fresh monthly lows over the last couple of months. RSI continues to be trading at 3-year lows, so the risk is still there to the downside. And we can see that the MACDs have not improved. MACDs trading at 3-year lows, and also MACDs trading below zero is a major problem. So I think here net we're still looking at markets that might be looking to go lower. Let's take a look at the Brazilian market. And let's go to the daily first. And on the daily, just want to show you that it had come back to test the top side resistance. If you draw it like that, coming back to test that line, I think around there it stalls, in my opinion. And keep in mind that this is also coming back to test the break line in December. So it broke down in December or November, broke down there off the highs there. If you draw a line which happens to be around the 50, you can see that it's coming back to test the same line. More than likely around here is where you'd expect it to start pulling back to be consistent with world markets. And also you can see that it had a nice gain on Thursday, up about 3%. Why? Because it moved its daily RSI above 50. If it has a reversal around here, it might have a big down day in the coming days, if and when it moves its daily RSI below 50. Now keep in mind that the monthly is no different than any other market across the globe. Right now we are still looking at the Brazilian market close to 3-year lows. Let me draw that properly. Close to 3-year lows on its RSI. If it cracks below 3-year lows, that's a major downside risk. And also we see that the MACDs have been trading bearish for quite a while, and also both MACDs below zero, not only below zero but also about to make fresh 3-year lows. So the risk continues to be to the downside, And I just want to conclude this by taking a look at the S&P 500 on the monthly. And guess what? Just like other markets, pretty much a mirror of all markets. And we can see here trading close to fresh 3-year lows on its monthly RSI. We've been saying this for a long time, that the more we are trading at 3-year lows on the RSI and MACDs, the more the risk continues to be to the downside. That hasn't changed. We take a look here at the MACDs for the SPX, and both MACDs are trading at 3-year lows. Recently, we saw a rejection here in the month of December as it tried to move above zero and failed. And we can see that the other MACD, the main MACD, default MACD, is now trading at fresh 3-year lows. So the risk worldwide, the risk in the US, risk in Asia, risk in Europe, is for markets to be trading lower. And if this chart is true and consistent with the historical performance, I've been saying this, and I've said this to my subscribers, that this might be a term that could be used sometime this year. As long as these charts are breaking down, this opens the possibility for some type of a crash type behavior. Wish you all the best. Eric Mwathe, Mwathe.com. Good luck as always. Peace and blessings. Mwah.